Hello guys, in this video I'm going to be showing us how to trade the derive synthetic index step index. I'm going to be doing a multi-time frame analysis where I will take us from the higher time frame to the lower time frame, such that for those of us that trade on the much higher time frame, I'll be showing us where to possibly sell this asset, and for those of us who trade on a much lower time frame, where we can possibly buy step index. So without wasting much time, let's get to it. I'm currently on the monthly time frame, and on this time frame, as is customary, what I try to do is to map out my key zones as well as get a directional bias. So first of all, how do we map out these key zones? We map out the key zones by using the rectangular bars to look at rejection areas on our price chart. And like I always say, these rejection areas, they shouldn't be areas that you would have to argue if they are rejection zones or not. There should be something that when somebody else sees it, the person should be able to quickly agree with you that, of course, price has been rejected in those areas. I have other videos in which I explained how this can be done. So you could be looking at me doing this very fast now because I've done this over and over again. So if you want to learn how to do this properly, you can check out the video on the channel. So as you can see very quickly, I've had my zones mapped out on this monthly time frame where price areas where price had been rejected severally in the past. And if I do not want to make the chart so cumbersome or busy, I could take these guys out so that I can concentrate on the most recent zones. So whichever way you choose to do this, then it's cool. So the next thing, like I said, will be our directional bias. Now, looking at the structure of the market before us, we can see that this market has been in a downtrend for quite some time now, and that's because from all indication we can see that the market has been giving us a series of lower highs and lower lows. So if this was a high, the market gave us a low and then gave us a lower high and came all the way down to give us a lower low, a lower high, a lower low, a lower high, gave us a lower low, and the market is currently retracing upward. So that gives us an idea that our directional bias, even though we're in a strong, even though we have a strong bearish market, our current directional bias is bullish in the sense that we can even see that this green candle is an indication of bias pushing price upward. So that means until otherwise, we'll be trying to look for opportunity to buy this particular market. However, we do still have to go to the much lower time frame to see if the early decision would work. So on the weekly time frame, we try to get like a structure of the market to work with. So you can see that we have our key zones or most relevant key zones mapped out already. We can see that even on the weekly time frame, it aligns with our initial take that the market is in a downtrend, and then the presence of buyers simply show that the market is making a retracement upwards. So on this time frame, like I said, the first thing would be to try to get the structure of the market to work with. So if I go to the line graph, the immediate structure that comes out to me is a simple bearish structure. Now, what do I mean by simple bearish structure? It means when you have something like this. So price comes to give you a low, and then we have like price trying to make what a lower high. So this is the structure that we have. And to trade this structure, all we simply need to do is to wait for price to come as close as possible to the lower high, and then we can start looking for opportunity to take our trade. So like I always say, price has a liberty to come all the way up to make a double top before thinking of heading downwards. So what I'm trying to say is until price takes out the most recent lower high, the market remains in a downtrend. But like I said, our directional bias is upwards because price is still in the process of giving us the next lower high before it continues in its ultimate downward direction. So having or bearing this in mind, that now takes us to when do we believe or when do we feel that price is ready to head downwards. Now, aside other factors like the structure and the nature of the candlesticks that we'll be seeing, if maybe we start seeing more of the bearish candles, then we can also use other tools such as the trend line to guide us, as well as a tool called the Fibonacci retracement tool. So if I place my trend line here, how would this guide me? We can see that it's, like I said, the trend line is a bounding line that helps us to note the direction of a particular asset. So for time passes, price has been hitting this trend line and pulling downwards. So this means that it is highly probable that when price gets to hit this trend line again, then price would likely come downward. So another tool in which I use in my analysis is the Fibonacci retracement tool. And the most important area in this tool for me is the zone between the 61.8% and 50% mark. Now we can see that the key level that we drew from the monthly time frame is almost aligning directly with this key zone, this zone that I call the Fibonacci retracement golden zone. And this zone is also resting closely on the trend line, the downward trend line. So remember, we're still on the weekly time frame. So price is pushing upwards. Even though I say that our directional bias is upward, which is the retracement, we can see that the best place or the best decision to make would be to continue following the trend of this market by waiting for price to come into this level, and then we try to sell. Now, this would be like a triple conference. We have a Fibonacci retracement golden zone. We have the major resistance level from the monthly time frame, and then we have what, a trend line, and then we have price very, very close to this key zone. So we have a set key zone, a very, very strong key zone, in which we expect that when price gets into it properly, and then we start seeing the presence of sellers, then we can start thinking of what, looking for selling opportunity. So the next thing now will be for us to go to the daily time frame. I call the daily time frame the tradable time frame. So remember, I said that our directional bias is bullish because price is currently retracing upwards. Now, if I'm to take out these other tools to make the chart less busy, let's take out the fib tool. So we can see that on the daily time frame, we have a strong presence of buyers. In other words, the buying momentum is still very strong. So even though our key zone for me would still be this level, the trend line and this resistance level. So because price had gone all the way up already, I wouldn't be favoring looking for buying opportunity. Why? Because the price is already very, very high. I would, however, be patiently waiting for price to come into this level. Let me mark out this zone. I'll be waiting for price to come into this level fully. And then when I start seeing the presence of sellers, then I can look for what, selling opportunities. So that would be if I were trading on the higher time frame. In other words, if I were a swing trader, or rather for swing traders, because I actually swing trade most of the time. So let's go down to the much lower time frame for those of us that trade on the lower time frame. So if you were starting your analysis from the H4 time frame, you'd see that you clearly be seeing only an uptrending market. How do I mean? So this would be what you'll be seeing, like the market making higher highs and higher lows. So you probably have like your trend line here and still be looking for what, buying opportunities. So if we are to zoom this out, or let me zoom in a bit, you would probably need to wait for price to make like a retracement into this level, and then you can look for what, buying opportunity. I, however, would not encourage this because we can see that from our journey from the higher time frame, price is already close to a very, very strong resistance zone that was made up of three components that helped us to form was the confluence for that zone, which included a strong resistance zone from the monthly time frame. We saw the Fibonacci retracement tool on the weekly time frame, and then the trend line also from the weekly time frame. So all this put together would definitely give us like a strong probability of price heading downwards again, because as we saw from the monthly time frame, the step index has been trending downwards for a very, very long time. So it wouldn't even make sense to start buying against a major trend. Another thing I'd like to draw attention to would be to notice the momentum of the upward movement. So if I should go to the H1 time frame, we can see that as compared to the daily time frame, the momentum is gradually reducing or decreasing because we are getting closer and closer to this major key zone that we saw from the monthly time frame. So a lot of people who have no idea of what's going on the much higher time frame will still be pumping in buys, and all of a sudden they'll see the market reversing against them and might not know why such is happening. So what I would advise is this: I would wait for the selling opportunity. I would, however, use this counter trend line on this 1 hour time frame as a guide. So in other words, you can pull this 1 hour time frame into the zone that we're expecting, such that even though price continues upwards, resist the temptation to keep buying. All you need to do would be to wait for price to come into this area, and once there's a break and then a retest of this area or of the 1 hour trend line, then you can start trying to get your sell trades, because it's going to be like a very, very long sell. So imagine if you're able to catch the trade here, you can hold it all the way up until the market gives us a new lower low. And of course, your stop losses would be above this level. So this is my simple take for the step index. So I personally, though the price is currently retracing upwards, I personally would want to wait for the selling opportunity, because it will be something that if you're able to get in, you can hold it for a very, very long time. So you can compare this with your analysis. I haven't looked into derivative synthetic indices for a while, so I decided to drop this video. So don't forget to like, share, and subscribe for subsequent videos. We'll be running a promo for our academy since December, and that will be coming to an end this January. So just before it comes to an end, you can reach out to us to see what it is all about. Do enjoy the rest of your day, and cheers.